Okay. Good morning, everybody. And something didn't work out right. Hold on. Good morning, everybody. I'm Doc McGraw, and welcome to our daily plan. And we have Val Trader here today. Welcome, Val. Let's put you on the stage. And I'm getting my chart ready. Val, say a few words to the folks while I get my chart ready.
You're getting your charts ready.
Yeah.
Okay. Yeah, I can feel like 5 minutes talking.
Good morning, Val.
So, yeah, good morning. What I find interesting today, mainly, I'll just say it short before we deep dive into the data, is obviously the gap, big gap. So if I'm an institution, I'm thinking, like, am I gonna chase this shit, or is that agreement they're doing bullshit, and this market will drop back to 6,500 SPX next week? I think it will drop back down.
Based on?
Well, I'll go into those details. I can go in right now. I don't have all the charts. I was moving around a bit, but I did have some scouts trading some scout trades out there. I got filled on some strange shit, and which makes me consider the downside much more than the upside for the next couple of days. And yeah, so if you want, I can go into the details. But if you want to do your
Please
thing
do.
first. What?
I'd like to hear it. Yeah.
Yeah.
But Doc, aren't you doing your thing first?
I just got my chart up.
Okay,
Give
no
me
problem.
5 minutes. Give me 5 minutes. You can go in your thing, and then
Yeah.
I'll do like.
Okay, so I'll go into a couple of details. So first of all, for today, my transition zone is 67.50 to 67.35. As
And
long as
that's
we're above
ES.
50 SPX.
Okay. Sorry. Go
As
ahead.
long as we're above that, I'm generally long. And if we reach to the downside, the 67.35, I'll be under the assumption we start to go down and close part of the gap between today and tomorrow. So above 50, I'm long. Under 35 SPX, I am short. Now, what drew my attention was yesterday I set up some put ratio spreads. I myself prefer to take the risk on the ratio spreads instead of having the full butterfly, because I'm not afraid of hedging and stuff, and it's part of what I do, so I don't care. But what was interesting is that I went and did a 125 point spread April 14, which is next Tuesday. I bought the put 6,700, sold two puts 65.75, so it's 125 point spread for credit. Now the payoff chart, the payoff chart, meaning where do I start losing? I start losing under 6,500. So until 6,500, from where we are now, I make money. Now it doesn't matter. The P&L thing is not really important for this idea or conversation. The point is that even though we saw the VIX dropping through those 23 handles, 22 handles, and we saw this huge gap, unsustainable in my eyes, those puts are priced super expensive, like super expensive. It's very uncommon at a VIX 20 to get a 125 point 4 days out for credit. Like, I don't remember when I did it. Maybe when no, didn't happen. Didn't happen during 2026. So it means that until April 14, the market thinks that this gap can be closed pretty violently also. And another interesting thing is I went and tried to do the same spread for April 17, next Friday. And I said, okay, if I got 125 points for credit, 3 days more than that, I should get 150 points, but I couldn't get it for credit. So for some reason, the market is pricing higher risk between now and April 14 than it's pricing between April 14 and April 17. It's only 3 days difference.
We have VIX free.
So yeah, considering the fact that the gap is up and everybody's happy and all this, I would expect those puts to trade much lower, not enabling me to do a 125 spread for credit. More like 90 point spread for credit would be natural if everything was so good and this gap would be sustainable. I would get a 90 point. So yeah, so that caught my attention. And again, for today, plain vanilla above, regardless of that position in my bias. Yeah, I trade the market. I don't trade my bias. Regardless of that,
100%.
Intraday above 67.50, I am long. I don't think there is a lot of upside, but I am long. And under 67.35 SPX, I am short, which if develops and gets some traction and doesn't mean revert on us, I will probably stay short into tomorrow.
Okay, great. Thanks a lot. And sorry, everybody, I didn't get my stuff up on time. With the change of with sunrise coming earlier and having to tend to the goats earlier, I don't get my note written before the goats. Anyway, that's a personal thing. None of your concern.
Doc, yes. if you can, well, not right now, but I mean, if you can set up those spreads so people can see that spread I did. Well, and then we can see the payoff.
What are your two strikes again?
The strikes are April 17.
Right.
I'm long put 6,700. Short two puts 65.75. So 125 point spread.
Okay. Got it.
And you can show the payoff and the cost and everything, so people can see that.
I could show it to them a few ways, and we could actually talk about that a little later on.
Yeah,
could do it naked, but that's no,
the idea, the point of showing it is more for the payoff chart to see where it cuts off, because that shows the distribution.
Right, and we could also show them how to do it with XSP or with SPY, roughly those numbers for less margin, or just to make it a wide broker and butterfly. So there's a few ways to skin that cat, is my point. Or doing it with E-mini, which then is much more forgiving margin-wise. So there's a number of ways to skin that cat. Okay, and that's an interesting trade. I might look to play with it.
Yeah, and one more thing, the spread is on the ES, not on the SPX.
Okay. Oh, so they're right. That's how and that's where the margins are more forgiving. Okay, so here we are at 67, 65, and I pretty much see the same levels that Val is seeing, and we often see the same levels. That's not surprising, but we come at it from similar-ish, but not the exact same angle. So let's cut to the tape. All right, so here we go. Okay, so by the way, we have PCE today, and I don't see much of a reaction in the Treasury. I don't see much of a reaction in E-mini. And I was kind of watching that to see how much the market, meaning the algo overlords, care or don't, how much they're focusing on these macroeconomic things, or unless there's a real outlier, is it like a yawn? And so far, it was a yawn. It looks like I don't see any volatility coming out in terms of reactions. I don't see any change in the 10-year Treasury. I see E-mini yawning. So interesting mental note for myself. Okay, so Wednesday, as we know, we had that relief rally. We can call it. We were up 2.5 points, 2.5% rather on the SPX, 2% plus on all the indices. And the real story is not everyone got bullish. Not like everybody took out their calculator and did a discounted cash flow model and decided that that's what SPX should be like. Long story short, the boat was overloaded to the left tail. VIX was high. People owned expensive puts. Those puts failed to materialize. When the market didn't crash, when it just kind of bled down, those puts bled out, but people were still over positioned to that side, and those puts were kind of sitting there. And then on Tuesday, the day before ceasefire day, they reloaded on some puts. We had downside convexity. I think we had a spot up, vol up day somewhere in there where they were actually buying puts on the way up, hedging for this. So all that evaporated, failed to materialize. As we moved up just a little bit, then those puts started to bleed out. There was large buyers in large size of 6,700 and 6,800 calls, short term as well as longer term tenors. And so all that caused this mechanical drift up. Right tail was underowned. On top of that, as I've mentioned, leverage ETFs had a buy. Now on days where we're up, 0.25%, we were moving like the normal, 0.5% kind of range. So a little buying, a little selling into the close doesn't typically materially move the tape, might a little bit. Yesterday, at the close, we had that buying that gave us a little 10-point pop toward the close. We also have CTAs and institutions broadly, vol control funds. Everybody lightened up their exposure, and now, based on their models, and I don't have the exact models, and people model out their models, they're going to be having to be buying X billions over the next course of time. So that's one side of the boat versus kind of some of the technicals that, we have this gap to fill below there. We're one headline or tweet away from a 1.5-point drop or, 100-point drop day or 75-point drop day. And with that, let's look at the positioning. Okay, so like I said here, the right tail was underowned. There were savvy upside bets. They came in recently. I have this new toy here. Oh man, but the link isn't live. Son of a bitch. All right. I'll go back to that in a minute. So let me find my provisional toy tool. Hold on. Because I'm real proud of this. No, yeah, I mean, it's got the fact that a baby boomer like me can make this is kind of amazing. All right, so let's blow this up. I'm going to show off for a second. So here's my VIX dashboard. And so here's the decomposition index yesterday. So most of the drop of the VIX was a sticky strike. We shifted, the curve shifted down. I have a little in plain English here. SPX jumped 166 points, a reef rally. The move alone did most of the work crushing VIX. When the market rallies hard, the fear gauge naturally resets lower. It wasn't just mechanical. Traders were generally pulled back on their hedges, fewer people buying put protection. Bottom line, 2/3 of the VIX drop was the rally itself. And the rest of it was a little bit of put skew, and the parallel shift means the whole curve just got repriced a little cheaper. Term structure. is back toward normalized. Holy shit, look at that. Upward slope, normal. Nothing much to say there. And these 3D surfaces, this is still a work in progress. And that's like a little heat map of this, of what's moved of the VIX 3 months, 6 months, and the VIX 1 year, just to kind of see how things are changing. These are I'm gonna be playing with, but that's the decomp index. That's my little toy. Control C. Putting the toy in the link here. The link was supposed to be live. I guess I didn't figure out how to do it. Okay. And that's, so more will be revealed on how that project progresses. Okay, so on to the earnings. We have some Fed speakers today. And again, I'm going to be watching to see how the market is reacting in general to more normal macro sort of considerations, interest rates, inflation. There's always the inflation narrative. You know, what the Fed going to say about one-time shock, you know, transitory with the oil thing, or, you know, or that whole thing. Plus, we have earnings season kicking off next week. The banks start next week, and I think some of the airlines are coming up, and then big tech will be coming. So, assuming there's no major distraction from this whole 2-week ceasefire, with, you can figure we're going to have the finger pointing accusations, you broke it, and whatever. So we're going to see how the market takes all that and doesn't take it in stride or not. Okay, let's get to the options deck. And those levels today are really clearly defined. We've got, and interesting what we've got going on here. We're framed by negative gamma over here at 6750 and positive gamma over here at 6820. So 6820, 25 and 6820, 30, 5 wide and 10 wide call spreads were sold here. But there's more of these than these. So there's more upside bets over here, up at 30, I guess it is, than the cushioning effect from here. So if we should get up towards 6,800 and can get up here, it could get kind of sticky. That said, I don't think that happens. Could get kind of funky in here. To the downside, we have a little stall area right here at 6870, 6780, 6770, kind of where we are. For those of you that are unfamiliar with how to read the options depth chart or with gamma in general, to the right is market makers long, sticky, mean reverting. Think of it as resistance or support. The difference being we tend to stick toward those levels rather than kind of reject off of them as hard as you might normally think of it. And to the left are, think of them as magnets and attractants, but in both directions. So as you head down, we accelerate, but as soon as the acceleration stops, it goes the other way. Okay, Henry said, the path of least resistance leads to crooked rivers and crooked man. Oh, I love that one. I love that one. Thank you. That's a good one. You know, I'll quick aside, around 8-10 years ago, I reread parts of On Walden Pond, probably for the first time since high school, or maybe in my hippie era. It was actually pretty good. Actually, I'm surprised at how. Anyway, I digress. The other interesting thing here is this negative gamma is not puts. It's not that somebody bought puts would have kind of made sense, buying puts and using selling calls to finance it. And actually, I did something like that yesterday, a small one just for science. I sold 68.20.25 and bought 67.50.45 for science. Of course, we got 30 cents. Anyone buying VIX calls? Not really. Nope. Very little action. VVIX went down. The VIX call trade is dead for now. It seems like the hedging is
There are
going
better
back
things to
toward near the
scalp.
money puts.
There are better things to scalp.
Yeah, and I mean, I have my usual call. I closed out maybe $1,000 worth of profit in short VIX calls yesterday. I still have short UVXY and some of that other stuff. The curve normalizes, which it always does. That was a little early, which I tend to be, and that's okay. So we will stay long now. Well, it depends on your time frame. But what's interesting here is the 67, 40, 50, that this 50 is a long call from an in the money call spread. So this call spread here is 67.40. So somebody sold the 67.40 and bought the 67.50, and now they're pretty underwater. That said, it doesn't matter who did it or why they did it. This has the effect of being supportive as we're above it, but also being magnetic, pulling us down toward it. That doesn't mean we can't break it. Should we break below 67.40 and Vol came up with 67.35, the same difference, potato, then that kind of the door opens down in this direction, 67.25 and lower, with nothing much here from a gamma point of view to stop it. So then you can rely on the expected move in the option chain. You could rely on whatever voodoo lines you have on your charts, whatever system got you here, MACD, RSI, Fibonacci, Gann square, whatever it is that you like. And so that's it. So it's a pretty clean, easy read. Between 50 and 68.20, call it 6,800 really, is we could kind of float in the balance area with a little bit of a bias towards staying stuck where we are now, or if we can get above, staying in this part of the range or in the lower part of the range, with the understanding that if the positioning stays roughly the same, if capital IF, then if then conditional, if then let's just say we're up in this area, 67, 90, 95 toward yesterday's high, then the mechanical drift would be higher toward the market maker long strike. This decays, and when we drift toward this strike, we don't go through it, typically. We kind of like we end up 6,800, 6,810. If, on the other hand, OTHO, if we're down 67, 80, 70 down here, and we have this little ladder pointing in this direction, then the mechanical drift would pull us toward 50 or maybe 40 toward the end of the day. And this is assuming there's no big shift in positions that comes up intraday. Typically, at the end of the day, we have clever algos. I don't know how clever they are. We have algos jumping in and buying 1,000 or 1,500 calls or puts, one strike out of the money. We see them starting to accumulate around 2:30, 3 o'clock, and that tends to tilt the charm profile in one direction or another. Then we'll often see them close out, and suddenly what looked like a mechanical drift up 5 points changes, and we kind of have fun playing with that in the Discord room. And that's basically the story for today. Next up, we have Badhombre, aka Chewy, aka Badhombre. What you got for us? Oh, VIX 21. Yeah, 20,
Sorry, guys.
20,
Thought I was, didn't know I was
25.
mute.
20, 22 and a half, 25 is the area I was looking at for VIX3. I've been saying 22.5 to 25 max, even when we were at 30. I'm still sticking with 22.5, and maybe 20 is interesting because there's a lot of customer long puts at 20. That's kind of interesting. So, okay, go ahead. Sorry.
All right, Doc, do you mind putting up a screen share of ES for me? I'll be uploading
Sure,
my chart here in the Discord
that
momentarily.
Okay. Where's the ES? Here we go.
All right,
So
guys.
here's the ES. And these are yesterday's lines. I didn't put the new lines on today yet, but good enough for now. I don't think the lines materially changed anyway. Go ahead. Can you see the screen?
All right. Yep. All right. So we're going to go over ES here, guys. We're hanging around 68.06. My ceiling for this today is going to be 68.30. And my floor is going to be 67.90. I've got a pivot currently at 68.02. So we're right above pivot as of now. I think where price goes from here is a quick push towards our ceiling. I don't think we make exactly our ceiling, but I think we'll see 68.20, maybe 68.28. But I'll be looking for a reject up there, back down to our pivot. If we hold, we're gonna say something.
So 20 points, so roughly 20 point upside, which would put us near yesterday's high of the day.
That's right. Mm-hmm. I even think we might even sweep that high, and then come right back down. I think that is very likely because I have a sticky level at 68.36. So if we go up there, we don't really break above 68.36. I think
I have a gamma level of 68.35. So okay.
All right. So I mean that's a good kind of rejection area for us to hold, or at least to slow down in, right? And if we slow down too much, I do think we snap back to pivot, which is a trade I'd be looking to take. And I think what excited is the wrong word, but I'm going to use it. What I'm most excited for is for price to go below my pivot 68.02, and then ride that down to my floor at 67.90. Do we break my floor? I don't think so. But if we do, I really like a flush down to 67.60, 67.45.
Okay, so that'll be a big flush down to 67.10 SPX-ish. If we break that 40-50 area that we've been talking about in SPX, the flush brings us down to 67.10-ish, which is roughly the bottom of the expected move when I looked this morning, or 6,700, big round number. Oh, by the way, we have some moving averages in play here. We're above them all, but the 200-day, let's take a quick look at that, just FYI. So 200-day is right here at 60, excuse me, the 200-day is right here at 66.55. And the 50-day is, give or take for government work, 67, 66, 65. So we're pretty much on the 50-day. We've got the 20 trying to curl up, the 50 trying to flatten, the 200 still in an uptrend. And, old school TA, when your moving averages are going in all different directions like that, it's no bueno for the trend. And that's basically it over here on this. Oh, and this is the expected move chart from last week, last Friday, this Friday. Notice we're above the expected move, but I don't think the expected move had a taco in it. And the expected move reflects the under-owned right tail and the overhead left tail. That doesn't mean, that wouldn't shock me if we came in and closed 6725-ish or 6700-ish on Friday. It wouldn't shock me if we stayed above this also, but overshooting it by this much on news makes sense. Not a big disaster, or not a big surprise, let me put it that way.
Yeah, it reached also last week, I see.
Hold on, let me go back to the chart. So here's last week. Last week we breached it again. And this tends to happen when positioning gets so one-sided like that. And you can kind of tell, at least I can kind of tell, when we're going to get a breach to one side or another. You can kind of get the feel. If that doesn't happen often, but you can kind of get a feel for when that's going to happen. I mean, you see, we tend to respect it. Okay, Val, you have charts for us?
No, we can recreate the position on your end.
Okay.
And the position is on the ES
Give me
options.
1 second here.
You can just show the like a clean chart of the SPX from the CBOE, and so people can see the range that those spreads cover, right?
Okay, we'll do a few different things here. Let's give me 1 second. All right, for fun. Okay, so the 14th, and we'll go back and forth.
This is ES, yeah. So you're along the 6700 put.
Okay.
And you're short to 60, 65, 75. You can just do 6600. Just do 6600. It will give
Keep
you
it simple. Okay.
Yeah, two of those against one of those. It should be around
285 debit. It's 285 debit.
Yeah, so it was trading for credit, but it doesn't really matter. Can you open the payoff chart for that?
Give me 1 second. So
that's where the information is.
Yeah. I'm not great with these payoff charts. I never really look at them. Anybody know how to look at these payoff charts? Because I always do it in my head. Give me 1 second. I always do the payoff charts in my head.
So we can just look at the daily chart of the CBOE index, and we can see the range there.
Let me see if I can figure out how to do this. Give me 1 second. Analysis. It's something I'm supposed to do here that's going to show me the payoff chart. I've had it before. Scale, maybe? Who knows how to do these payoff charts on Tasty? Delta.
You want P&L if you have that option.
P&L exploration. But nothing is happening here when I do this. It's just showing a flat curve.
So just open the chart, the trading view chart.
Check the zoom. Okay. Oh, the zoom. Okay. There you go. We have a genius. Thank you.
Okay.
That's what I've been doing wrong all the time. Thank you.
Yeah, but that's not
that's a little better. Okay.
That's not the payoff chart of the strategy. Yeah. That's something else. No. For sure, it's not a P&L. The P&L cannot be curvature.
Okay, that's the delta. Okay, who knows how to do it? I mean, you can kind of clearly see where the P&L is gonna kick in, can't you?
No, this
It's gonna
is
kick,
this
it's gonna kick
this
in over
doesn't
here.
this doesn't really make sense either way.
Who's good with these charts here? Like I said, I never use them. Hold on, we have some numbers down here.
The delta obviously is negative, and then crosses to positive as you go down. Yeah.
So it looks like 65. It looks like the P&L line is right around here, 65.40.
No, I think it's better you open a regular chart. Otherwise, we're missing the point of the information. This chart doesn't convey
Okay. So
too
here's a
much.
regular chart.
Yeah, so
That's why I
just
never
load
use it.
the
Maybe if I knew how
SPX.
to use it, I would. Go ahead. Here's the chart.
Just
Want it
load
daily or
SPX daily from CBOE, not from something else.
SPX daily? You're making me work here, dude.
Well, do you see where it says 5 minutes up in your chart? Just change that to 1 day.
Right. Yeah, you can change that to a daily, right? And SPX, not ES, right?
SPX from CBOE. Right. Now, if you zoom in a bit, yeah, that's it. So basically, now use a rectangle just to cover the section of the P&L of the P&L. The rectangle covers 6,700 down to 6,470. Sorry, on the
60.
my bad. It's not SPX, it's ES.
That's what I thought. Okay.
Yeah, my
But my
bad.
ES chart is not as marked up as this, so.
Okay. So the rectangle starts 6,700 down to 6,470, even 6,450. So it covers 250 points before the strategy goes negative. It's under the brush. You have the rectangle under the brush. Click to the right of the brush. You have a small arrow there to the right. Yeah.
Okay.
Then you have a rectangle down there.
Rectangle. There you go. See that? You're
Yeah.
teaching me shit. Okay. Where do I put my rectangle?
So you just want to close to the price rate, to the price axis, just mark a rectangle going from 6,700 down to 6,450. Right. Now, you would agree this is pretty much wide before you go negative on a strategy which is 4 days out. So
Right.
what this means is that the skew is very short, it's very put skewed actually, even though you would not see this by the VIX going down. It basically, the curvature is very sharp to the upside as you drop from 6,700, and it means that regardless of what any one of us think about what's going to happen between now and next week due to the war and everything, those puts are very, very rich, like very rich. And that's why you get a coverage of such a wide range, which from my experience being 4 days out, 5 days out, that's pretty expensive, right? That's pretty expensive. So now one could argue that because it includes a weekend, then there's some premium there that is scattered over Monday and Tuesday, which elevates those premiums to get you this coverage. Now, interestingly enough, if you were to do the same strategy into April 17, you will get pretty much the same, maybe 10 points more in terms of the coverage. So for some reason, the market thinks that there is much more risk into April 17 than after it, right? And so in my eyes, regardless of the fact that economically this is worthwhile for those that take the risk of, obviously, you're basically short one naked put here, yeah? But regardless of that, in my eyes, this clearly shows that the market is still very much concerned about the downside, specifically this huge gap and its potential to be closed between now and April 17. That range that the strategy covers, which basically gives you a credit on a 125 points, indicates they think there's a very high chance that the gap will either fully close, partially close, but for sure these levels will not be sustained. Now, whether the market is correct or not, yet to be seen, but they are putting their money where their mouth is. And so I jumped on that, and I think it's a good, risk reward. Obviously, choosing the ES enables me to react 26/7, and good enough for me, right? Not recommended to do anything like that because of the unlimited risk potential in being short a put, but I can handle that. And I think the information is more interesting than the P&L aspect and all that. So just to summarize it, that range that you receive from the strategy is very large relative to what I generally see. And I do a lot of options on the ES, and that infers that the market assumes a high chance of the gap being either partially closed, partially meaning at least half of the gap being closed, or fully closed by Tuesday.
Okay, so I'm just playing around here. One wanted to do a put butterfly on SPY, because a lot of people, don't want to throw that much capital at it. And I'm just going to kind of think a little creatively here. I don't usually trade SPY, so I'm not super familiar with the SPY numbers. But let's just kind of play around real quick.
Well, I can tell you exactly the conversion to ES. 1 second. So the conversion to ES is 10.10. So you basically multiply the SPY by 10.10, it gives you the ES.
So 660 SPY would be your long strike?
So 6,700 by 1010.
6,700, okay. So 670, we'll call it.
It's 66, actually 67 by 1010 is 66.3 spot 3.
66, okay, we're going to call it 67. Fine. And then your short strike is what?
The short strike is 6,600 in this example we did.
No, I thought that was your long strike. 6,600, right? Okay, so that would be 660, 657.
So it's the strikes on the SPY should be 663 spot 5 and 653 spot 5. Okay, 663 spot 5, 653 spot 5.
I'm gonna guess skew it a little bit.
Right, it's a 10-point gap, which is equivalent almost to those 100 right. Points. Now, theoretically, the 653 is trading expensive. So if you have that as a center of any fly you do, let's say 50 white fly or so, if you play around with the width, that strike should be at the middle, and it should provide.
Okay, so this could give you a 20-cent credit. 652 short times 3, that gives you your extra one. 642 on the bottom if you want to make it a fly. So we have an asymmetrical fly, 662, 652, 642 for a 20-cent credit.
That's pretty good.
Yeah, that's not bad. I'm going to put one in for science. Okay, let's see what happens. I'll report back to you all. Worst case scenario, I'm the proud owner of 100 shares of SPY at 652, which that would be okay.
Yeah, now there's a lot of outcomes. Some of them might be the market goes down slowly, which is the best scenario.
Right.
Others might be that by the end of Friday or Monday, those puts are zero. You can buy them back, and you're left with the long put for free.
Right. Yeah. There's a lot of ways you can play this once you have the structure.
Yeah, obviously, if the market gaps down 3%, then I'm screwed. But other than that,
right.
Yeah, and it doesn't gap down on Globex 3%, but just
And the
theoretically.
expected move for the one I set up is 15 points. And so it's kind of pretty far outside the expected move of the short strike. So it's nothing crazy, nothing crazy. The 16 delta, roughly the short strike. So nothing crazy. Okay.
Yeah, so those put buyers are basically making these spreads or butterfly very attractive, and they don't care about that. They just want to bid those puts.
And now the bid has bled out of those puts because I had a lot of short puts that I closed out yesterday. If you think they're expensive now, they were crazy expensive about a week or two, a couple of weeks ago. In February, you could buy 2 or 3 out of the money calls, roughly the same delta for 1 out of the money put. Skew was crazy. So I kind of played that trade a little bit. And it finally paid off bigly yesterday. It was just kind of bleeding on both sides, a little bit green because the put decay, and then yesterday it just exploded. I did it small for science, but still it was fun. Okay, anyway, guys, we're going to wrap it up here. And trade safe, click like, subscribe on Twitter. Retweet this, whatever it is. And let me know how you like that new toy, that new volatility thing that I'm playing with. Okay, thanks a lot, everybody.
Bye-bye.
All right, buddy.